Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are solving Zeddemore company question. As you can see, I'm doing it on the ACCA practice platform. If you have the Kaplan kit, this is question number 322 from your exam kit, but if I would really recommend, I would highly recommend that you open the ACCA practice platform and solve it over there. So this is a past paper question. As you can see, this was asked in March-June 2021 exam. So without any further ado, let's get started. Let me first read the requirements and then I'll dive deeper into the case study. So first requirement wants me to use the capital asset pricing model, the CAPM, to calculate Zeddemore company's current cost of equity and a project specific cost of equity suitable for the new venture. And for 2 marks as a next part of the same requirement A, I have to answer that referring to the calculations that I do in part I over here, I have to comment briefly on the view of the commercial director. So let's get started. Let's read the scenario. Zeddemore Company is a listed company in the house construction industry. Over the past 5 years, results have been disappointing, and as a result, the share price has fallen from a high of $3.5 per share 5 years ago to only $1.05 per share today. This deterioration in the performance and a share price has been accompanied by an increase in financial gearing to a high level. So I can see this is something problematic over here. This company has a lot of financial gearing, which means a lot of debt in their capital structure. So the capital structure is also given to us here. The share capital of $40 million, retained earnings 35 million, and you can see a debt irredeemable loan notes of $250 million and then a $20 million bank loan. So this is what their capital structure looks like. Zeddemore Company's loan notes are quoted at $65 per loan note, and both the loan notes and the bank loan are secured. Zeddemore Company's equity beta is 2.3, and then we have some information regarding the new venture. So with regards to the current KE, I have all of the information. I have read it also. So let us solve part A, part I, wherein I am first calculating the current KE, the current cost of equity. So I have to use the CAPM model, which has the formula that I have to take the risk-free premium, add to that the product of the equity beta and the market risk premium. So let me see what the risk-free rate is given. The risk-free rate is given to be 4% and the expected return on the market portfolio is 10%. So I have to calculate the premium. So that would be the excess return on the market. That means a market return minus the risk-free return will give me the market premium. So I can simply use the formula equals 4% plus 10% minus 4%. This gives me the premium. And then I multiply that by the equity beta. So the equity beta of Zeddemore Company is given to me as 2.3 over here. So with this, I hit enter. And if I convert this to a percentage, I have my cost of equity, which is 17.8%. Now, I have calculated the current cost of equity. Now I have to calculate the project specific cost of equity regarding the new venture. So let me read the information about the same. To improve performance, Zeddemore Company is considering the construction of commercial properties such as office blocks and industrial complexes. This is a new activity for this company and it is expected that the risks involved will be different from its current activity. The financial director has proposed that a project-specific discount rate should be used to appraise the new venture, but the commercial director does not believe that this is necessary. So they have two, conflicting views over here. A person is thinking something and the other person is thinking some other thing. So let's read further. Winston Commercial Properties, WCP, undertakes commercial construction projects similar to those being considered by Zeddemore Company. WCP has an equity beta of 1.25. WCP has $100 million worth of ordinary shares in issue, currently quoted at $2.6 per $1 nominal value ordinary share. The company also have $110 million of loan notes in issue, currently quoted at $96 per $100 of nominal value. And we have both companies pay a tax of 20% and the risk-free rate as well as the expected return on the market portfolio. So over here, what we'll do is the company that we take as a proxy for calculating the project specific KE is going to be this WCP company, because they are taking similar construction projects which are being considered by our company. So the first step that I do is, because I have their equity beta given to me, I need their asset beta. So I need to de-gear the proxy beta first. So I can put over here project specific KE. So the first thing that I do is take the equity beta of WCP. So equity beta of WCP is given to me as 1.25. This is their equity beta. Now I need to find out the asset beta. So I'm going to use the formula over here. For those of you who do not know, this formula is also given in your exam. So if you go to help or formula sheet, then you click on formula sheet. With this, you have all of the formulas all given to you in this formula sheet, the tables as well. So this over here is the formula that I am looking for. This over here is going to help me find the beta asset. So I'm going to keep this open for you guys to refer if you want to. Let me make this a little bit smaller so that we can also read the question and have the Excel, numbers that we can put in. So it will not allow me to have this open while using the Excel also. So I can just read the formula from here and then shut it. So I can see it's value of equity divided by value of equity plus value of debt into 1 minus t multiplied by beta equity. So over here, I'm going to have to use a lot of brackets so that I ensure that I'm getting the correct answer with me. Let's move ahead. So I have the equity beta all written, but I need the numerators and denominators first. So first of all, my numerator is going to be the value of equity. So it's saying that WCP has $100 million of ordinary shares currently quoted at 2.6. So, and their nominal value is also $1. So that means I have 100 million shares in issue. So that means 100 multiplied by the share price, which is 2.6. So this is the value of my equity. And then I divide that by the total of my equity and debt. So I have my value of equity again as 100 multiplied by 2.6. And then I add to it my value of debt into 1 minus t. So my value of debt is supposed to be 110 million of loan notes in issue, currently quoted at 96 per $100 nominal value. So what I'm going to do is I'm also going to need the number of loan notes that I have in issue. So for that, it's going to be 110 million, which has to be divided by 100. So if I just manually do that calculation and put it out over here, because I already have the formula open, it's 110 million. Dividing that by 100, I arrive at uh, 11 1.1 million actually. So this is going to be 1.1 million multiplied by 96, and the same has to be multiplied by 1 minus t. Tax rate is 20%, so I can simply say 80% of this value over here. And this is my entire thing. Now I have to multiply this with the equity beta to find out the asset beta. So if I just close all of these brackets and then multiply the equity beta, then I will arrive at the value. So with this, you can see that I'm getting my asset beta as 0.94. You can put it to 2 decimal places just so that the presentation looks good. So now I have the asset beta specific to this industry where they are taking up construction projects. So now that I have my asset beta, I have to now re-gear it according to the capital structure of my company, which is Zeddemore company. So now, firstly, I'm going to need the value of equity. Let us lay down separate calculations over here. So let us first take value of equity. I think the information, yeah. The information is over here. We have $40 million worth of capital, and one share is 0.5 worth in nominal value. So to find out the number of shares, I'm going to take 40 divided by 0.5, and then I multiply the number of shares with the share price today. So the share price today is already given as 1.05. So this is the value. 84 million is the value of my equity today. And then if I find out the value of debt, the value of debt is nothing but, let me first find out the number of loan notes. So it is 250 million. So let us do it roughly over here, 250 million. And then 100 is the value per loan note. So if you see, this works out to be 2.5 million, right? So we take 2.5 million over here, which is the number of loan notes, and I multiplied that by the value per loan note. So it is at $65 per loan note. So if I multiply this, I have the value of debt also. Now, if I have to so this is just regarding the loan notes. Now, in my debt, I also have the bank loan. So value of bank loan. Bank loan is not tradable in the market. So whatever is the book value is what is going to be the market value. So I take 20 million. Now the total value of my debt comes out to be the sum of this and this. 182.5 is the total value of my debt. Now I'm going to have to use this formula again, but I'm going to have to reverse it because now I have the asset beta with me and now I need the equity beta. So what happens is, using transposition, I'm going to find out that now in my numerator, I'm going to find the bigger value, and then in my denominator, I just have the value of equity. So let us find the equity beta over here. So firstly, I take the numerator. So the numerator is going to be 84 plus the value of my debt multiplied by 1 minus t. The tax rate is 20%. So I can straight away put it at 80% over here. Multiplied by 80%, this has become my numerator. Now the denominator is going to be plainly the value of my equity. Now this is something which I have to now multiply with the asset beta. So I put in more brackets so that the entire figure gets multiplied with the asset beta. Now I have arrived at my my equity beta, which is 2.58. Again, for simplicity, let's put it to 2 decimal places. Now we have to find out the KE. So let's use the CAPM model. So the KE over here is going to be my risk-free rate of 4% plus the market risk premium of 6% multiplied by the equity beta, which we have over here. And if you just convert it to a percentage, you have your cost of equity over here. So with this, we are done with the first part, part A and I part. So now let's talk about the part 2. Part 2 says, referring to the calculations above, briefly comment on the view of the commercial director. So the financial director has proposed that a project-specific discount rate should be used to appraise the new venture, but the commercial director does not think that this is necessary. So what comment over here is, something that you have to provide is, if you see the current cost of equity, you have 17.8%, but if you have found out the risk-adjusted KE, you see that the cost of equity has gone up. So this means that if you take up this project, the shareholders are going to expect a higher return to compensate for the higher risk that they are taking with the new venture. So if you continue to appraise the project using the same existing cost of equity, which is something that the commercial director is advising, this would result in an overstatement of the NPV, because if you use a lower rate, you get a higher NPV. So this leads to overstatement of your NPV. And if at all you're using such a low rate, then you may also lead to taking an incorrect decision. So this is what you will write for the comment for 2 marks over here. Let's move ahead. Part B wants me to discuss 3 problems that Zeddemore company may be facing as a result of its current high level of gearing. Now, this is a pretty much straightforward question. You would have also studied this in your content in the study hub. If you have covered your syllabus from there, you would have found this topic. So the points which you can possibly write about over here is that increased earnings volatility. That means, because if you have a high level of debt, you have to pay interest no matter what happens. So even if you make a profit, even if you make a loss, you need to pay the interest. So if at all you are not making enough profits, you still have to pay for the interest. That is why there's going to be an increased volatility when it comes to earnings, because maybe the profits have not been so good, but then all of the money has went away in interest payments, and nothing is actually left for the shareholders. So this is what you mean by increase in earnings volatility. Then if you talk about the cost of equity is definitely going to go up, because when a company is taking high gearing, the shareholders are exposed to a higher risk, because with debt comes increased financial risk. So in order to be compensated for that risk, they will have to get a higher return from the company, and that's going to lead to an increase in the cost of equity, as we saw in the previous numerical that we were doing also, that earlier their cost was around 17.8%, but now it had risen to higher than 19%. So this is how your cost of equity also goes up if you have a lot of gearing. And then another thing could be the debt capacity. So if the company is taking more and more of debt, they are eventually going to run out of the capacity to raise more debt. And if in the future they want to do something, they're going to find it very difficult to raise more money through debt. So these are a few points which you can mention over here. Another thing, if you want to write about, could be that there's a bankruptcy risk. Now, what do we mean by bankruptcy risk is that there's a risk that if the company is not able to pay off all of its interests and all of the principal payments back, then there can be a forced liquidation, which means the people who have lent company the money may go to the courts, and the courts may order that the company has to be liquidated, so that all of the people who have lent money to the company can be paid back. So this is how you answer part B over here. Now let us move to part C. This is the last part. So in respect of both equity and debt, discuss the risk return relationship and how it affects this company's financing costs. So let us first talk about the risk return relationship. So basically this means that if someone is taking a given level of risk, how much return they should be getting. So usually the return that an investor is expecting is primarily dependent upon the risk that the investment has. So if I'm taking a higher risk, I'm going to expect higher return in order to compensate for the risk. And if I'm investing in a low risk investment, that means I'm going to require a lower return because I'm not taking a lot of risk. So, if I'm a person if I'm an investor who's rational, who thinks logically, then I will not invest in any security in any investment which has a high risk but is offering a low return, because why will I take so much risk when such a low return can be offered by other investments which are low in risk? So vice versa, this is going to happen. And if a low risk investment is giving high returns, this will not be there in the market, because that security will be overvalued. Everyone would want to buy that security, and eventually it's going to become the returns are going to become lesser, and then it gets compensated. And then if there's a high demand for this investment, the prices increase, and then therefore the return reduces. So this is how, if at all there's any misprice, any undervaluation, or any overvaluation, this is how the markets correct such valuations. Then let's talk about Zeddemore's financing costs. So basically, the risk return relationship will be different when it comes to shareholders and lenders. So when you talk about the equity shareholders, they really have no guaranteed return per se, because the company is not bound to pay them any dividends. And even an increase in the share price is not something which is guaranteed. So equity shareholders come last in the order of payment, even if the company gets liquidated. So usually, if you see, shareholders are taking a lot of risk, and that is why they demand a higher return. Now, if you talk about the debt holders, for example, the loan note holders and the bank, they are facing a very low risk, because all of the loan which they have given us is secured, which means we have given some assets as a security to them, that if we are not able to pay the loan, then you can sell off these assets to realize the money. So this is how, because they are taking lesser risk, the cost of debt is also lesser, and because equity holders are taking more risk, the cost of equity is higher. So this is how you will explain for 6 marks. It has to be well defined, proper 3 points, where you three small paragraphs where you explain all of these things which I just talked about, and you'll be good to go. So with this, we have come to an end to this question. I hope that this was useful. If you want me to solve any more questions, you can let me know in the comments down below. Thank you for watching.